Howdy, Jacob here. Today we're looking at flowers, foods. Let's get into some of the financials here. So, 4.07% dividend yield, $4.8 billion market cap, $5.8 billion enterprise value, so about $1 billion net debt. From initial view on PE price to book, doesn't look super cheap. Return on invested capital is reasonable, I guess. I don't know if that's greater than or less than their weighted average cost of capital, but it probably is right around there. So uh, let's look at where this debt situation is. So 892 million long-term debt, 237 million in capital leases, only 165 in cash equivalent. So long-term debt, let's say about 900, and then free cash flow 200, 150, 350, 360, 260. So it's less than 5 years. Their 5 year average free cash flow to pay off their debt. So that's pretty reasonable. As for the dividend, 193 million being paid out. That is a hefty amount. It's a pretty hefty amount. I think we can. I think we can say if we look at about a 5 year average, that's like 80% payout. So good amount paid out there. Um, it's like otherwise with their money, buy back a tiny bit of shares, make some acquisitions here, issue a little bit of debt to pay for that acquisition. We'll see how that works out, but I think we can start making some assumptions here. So 10 years ago, about 3.7 billion, and now with the presume that's with the acquisition 4.8. Doesn't look like it's a sexy business from a growth perspective, but non-sexy businesses can still be absolutely fantastic investments. So for now, um, I might assume 2% revenue growth, 12 on the P and price free cash flow to be a bit conservative. And then as for margins go, about 4%, about 5%. Let's do 4.5, 5.5. Let's do 4 and 5 with, um, I mean, they do have a little bit of debt, so just bumping it down maybe 0.5% due to increase in interest expense. And so as for share change, it's been relatively flat. And I mean, it's an 80% out payout, but it doesn't look like they really use cash. Maybe every couple years they have an acquisition. So I think that 92 cents is relatively reasonable. So I think we should be fine with keeping that there for the next 7 years. But with these assumptions, it looks like it's still going to have to fall quite a bit, about 59%, before it gets to a price that gives us a roughly 15% yield on our return. So for now, I think it's definitely a company that could be considered in the dividend yield stock list. But for now, I'm just waiting. Thank you, and have a good rest of your day.